Hello, Uncle Jim here. Today I want to share with you how selling covered calls during a bear market can really be a good thing. You can really add additional cash to your account and weather the bear market a lot better. In this video, I'm actually going to talk about how I sell covered calls, how I set up my accounts to be able to do it. And then I'm also going to share with you how to actually sell a covered call on Schwab. So stay tuned. I think you're really going to enjoy what I have for you today. Okay, now before I jump into my discussion of selling covered calls in a bear market, I do want to talk about some trades I had earlier in the week. On Tuesday, which was July 5th, I actually had two really good trades that I made just shy of $500 in probably 30 to 40 minutes. The trades are actually displayed here at the top of the screen. The first one was Devon Energy, and I did nearly $300 with it, and it was credit put credit spread. And the other one was BGFV. I actually rolled it out to October 21st, 22. And this is Big Five Sporting Goods. And it's another company I really like to pay a good dividend. And I've been able to make pretty good premium with it. So over $200. And for those two trades on Tuesday, I made nearly $500. So again, 492. I share these kind of trades with my patrons. So when I do make them, I actually post details about the trade. I talk about the companies, why I like them, why I decided to trade in them or on them. And I also talk about the delta and why I chose the specific expirations and strikes that I did. So it gives my patrons, a little bit more detail than what I typically share in these videos. If you're interested in taking a look, I've got links down below with my membership. So take a look. You might find it's really worth your while. Now, turning to cover calls in bear markets, a lot of people are against selling cover calls during bear markets. I think it should be part of anyone's strategy. I feel like it allows you to bring in a little bit extra income, especially when some of your positions may be deep in the money, your puts, vertical put credit spreads, or cash secured puts. And it also allows you to take advantage of these bumps. I call them like bear market bounces that I think we had one 2 weeks ago, and like we hit a low and then we bounce back. And when we bounce back, it's a good time to actually sell a covered call or multiple covered calls and be able to bring in some additional cash. And I've been able to do that in the trade at the end of the video. I actually share a cover call I did in Coca-Cola. I encourage you to take a look at that at the end of the video. And I did quite well with that trade too. In order to do more cover calls, I also look at making adjustments to my accounts. Any odd lots, like I had 185 shares of SCHD, which is the Schwab ETF, dividend ETF, and I actually bought another 15 shares of that. Now I've got over 200 shares. So rounding any odd lots you might have to 100 really can make a difference with selling covered calls. So in that example with SCHD, I can actually sell two covered calls, and I'm looking at doing that and could bring in even more cash with that. And then the other thing, with the fact that we're in a bear market and it's going up and down, I've been able to close quite a few of my covered calls and then open up new ones when we get a bounce. So it's something else that if you're watching, what you're doing and keeping track of your covered calls and how profitable they are, I typically will close anything that's better than 85%. But I have been known to go a little bit below 80%, especially if I can get out of them and open up another one and bring in more cash. I've actually also closed some covered calls and then open them at a lower value, especially if it's an ETF that's gone down 30-40% and it's now I can actually sell the covered call at a lower value. I'll go ahead and do that a lot of times. And then I've also allowed some assignments, especially in stocks that I know that I really want to own. I talked about that in previous videos. For instance, Cisco. Now I have, I believe, 200 shares in Cisco that I can write a covered call on. Also did that with Fidelity National, which is not Fidelity, the financial company that a lot of people, I even made the mistake of not realizing it wasn't that Fidelity. It's an insurance company, Fidelity. It's FNF, I believe, is its ticker. And now I own 100 shares of that, and it has really good premium for calls. So I'm going to look at actually selling a covered call on it too. And then, the other part is it's really nice in the sense with the fact that the market moves so much, you'll find that things come in and out, of being in the money and out of the money. And if you manage that and you buy yourself a little bit more time, it allows you to manage a lot of these trades. To give you a for instance, my guess is when the market does recover, it's going to jump pretty quickly when it does get into that recovery mode. And some of my stocks or my trades that are currently in the money, they will probably come out of the money or, be a lot less deep in the money if you get my drift. So being able to sell covered calls gives you the opportunity to wait a little bit longer to not have to sell for a loss or roll, to a point where you're having to majorly widen the spread. So overall, I feel like cover call should be part of anyone's strategy. And I have had people tell me that they don't sell cover calls; they only sell, you know, puts and cash secured puts and vertical put credit spreads. But I think anyone, especially in this kind of a market, really needs to be doing both. It's worked out really well for me. So, well, that's it related to cover calls. The next part of this video, I actually jump into selling a cover call. I talk about why I sold the cover call in Coca-Cola, and I go into a lot more detail and how you especially do it on Schwab. This can also be translated to other brokers, but I found Schwab is really easy to use, and doing market trades is, one way for me to make it very passive. I get in and out and I go on and do other things. So please stay tuned for this next part of the video. And as always, please hit that like button and subscribe. Still trying to grow the channel, trying to get the word out. And thanks for joining me. And let's jump into that next part of the video. Okay, I've opened up Schwab and I've brought up Coca-Cola. I want to actually sell some covered calls in Coca-Cola, so I'm going to show you how to do that in Schwab. First, I wanted to show you the graph of Coca-Cola, and you can see it for a long period of time. It was going down, and then this was, I believe, after the 2008 recession, and it wasn't for a long time that it ever reached its where it was before, which was, I believe, around 45. I believe that took something like, what was that, 2000 and, is that 2013, all the way from 2000 or 1998 to 2013. So it took that long for it to reach what it was back in 98. So you can see this trend. It also dropped majorly back with 2000 when because of the pandemic and the market huge drop because of the pandemic, but it's been on an upward trend, and it's still within $2 of its all-time high. So it's a really good company. I own quite a few shares, so I find that selling covered calls is a great way to earn extra income. And once you determine you want to sell it, so here, or not sell it, to sell some covered calls on it, you can come over and I'll open up a different page. And here you can actually see the options chain. And I like to switch to look at Greek. So even with selling covered calls, and with my new strategy, I'm still sticking to a 20 delta with covered calls. With cash secured puts and vertical put credit spreads, I'm using something more along the lines of a 15 delta, which is like an 85% chance. So I'm taking a little less risk with selling puts versus selling covered calls, and that's primarily in since I'm primarily selling covered calls with companies I'm aware of and have a pretty good feel for what's going to happen with them. I don't feel like it's as risky as selling puts. So let's actually look at this. So I'm going to look at a 20 delta. Now I don't want to sell any that are going to expire in the next couple of days. So I want to go a little farther out. So let's look at August 5th. and I'm going to do around a 20 delta. Let's change this to 14 strikes. And you can see right here, well, I'm not doing puts, I'm doing calls, so I want to be over here. And the darker shade means they're in the money, meaning Coca-Cola right now is, I believe, $63. So that's where you see these up here are shaded, meaning that they're in the money. These are outside the money. So I want something outside the money, and I want it around a 20 delta. So this row right here is a 20 delta. So at 67, that would be a 20 delta, and I could earn $45 per share. But I really want to earn more money than that. So let's go a little farther out. I can do August 19th. And again, if I only had, three or 400 shares, then I probably wouldn't be going so far out. But again, I have lots of shares. I think I have over 4,000 shares, mainly because these were given to me. I inherited them when I was 16, 17 years old. So they've gone up in value quite a bit, and the cost basis is outrageously low. So selling these is like, if I sell these shares, the cost basis is so low, it's just like pure income, and it'll hit my taxes pretty hard. Um, so let's go a little farther out, 79 days, and let's see what a 20 delta picks up here. So again, it's right between 13 and 24. So you never can, rarely can you find truly a 20 delta. So you're talking $87 for a 24 delta, and for a 13 delta, $40. So a little better. I mean, the 87's not bad, and I'll probably sell two today. So let's go a little farther out. Let's look at the November 18, and again, let's go to the 20 delta. So 22, a little closer, and around $100 for selling one contract, which is 100 shares. So, not bad. If I do two of these, I'll get 200. But I want to go a little farther out, mainly because what I'm doing is trying to chain these. So I have shares that I'm selling up, cover calls on different expirations, and I've got like anywhere from four, usually up to four expiring on any particular expiration. So I do know that one expiration where I don't have any expiring is this February 17th. So let's jump into that, and let's see what a 20 delta. So you got a 15 delta is 74, and for a 28 delta, which is $70, and again, Coca-Cola is around 62. So in a little more than 6 months, I believe it's 8 months, would Coke go up to 70? Well, it could, but I don't know if it'll go that high. So, and since my choices are a 15 delta or 28 delta, 70, and it comes down to 70 or $75. So if I wanted to take less risk, I would probably look at the 75. But I was hoping that would be a little bit higher. I wonder if Coca-Cola, it's up by 1%. You can barely see it here. I can move this over. Yeah, it's up by 0.635%. The reason I have this over here is to cover up my account number. If I come up here, hopefully, yep, it's still covered up. So I'm not getting very good premium for that. So let's look at the June 16th, which is about a year. So in a sense, if I can get 10% increase in Coca-Cola in a year, which would be again around 70, let's see what the 22 delta. So we have a 21 delta, and it's $1.45. That's more like what I like. And $75, I would be surprised if Coca-Cola got that high. I believe it could get up to 70, maybe 72.50. Very unlikely. 75, I wouldn't be surprised if Coke actually drops back into the high 50s at some point late this year. So, and then of course, once you sell these and Coke is up so high, if it drops down to the mid 50s, I can close these for pretty nice profit, probably 70, 80, maybe even 90% profit. So what I'm going to look at is I'm going to select this, and I'm going to come back, and I believe it's in June, so I'm going a little farther out. I'm going to change just the calls, and let's go back to June. And you can see where I selected it. So here you can see I'm not alone. A lot of people are 599 and 73 in volume. So a lot of open interest and a fair amount of volume, quite a bit of volume right around that too. And it's up quite a bit today. So a lot of people are doing this 75. So I'm going to click on trade, and I'm going to say, so here you can see it's a call, it's Coca-Cola. And if I scroll down here, again, you're seeing it, the expiration 616, this is Coca-Cola. It filled in most of this for me. Again, a call. I want to do sell to open. So it's a contract. I'm selling it to open, where someone will be buying it, and they're choosing to buy a call at $75. So they think Coke will go up to above 75 so they can profit from it. And I really want to do two contracts. So I'm going to do two contracts. And I do market orders. I don't want to stay here all day trying to make a couple extra dollars. So I'm more than happy to make $298 and be done for the day. And so we can look, the bid is 149, the ask is 169. And with doing a market order, it'll happen right away. And they guarantee, let's see what they guarantee. They usually 298 is what they're guaranteeing. We can click on review order, and at this point they have it in the system. They're kind of guaranteeing that you'll do at least 298. This is what the fees are. Now, what Schwab likes to do is they potentially will improve the trade, meaning you might find that you make a little bit more than the 298. It may come out a little bit over 300, but we'll see that at the very end. They'll show it in the review of the trade after you post it. So the difference with doing the market trade is click it, as soon as I click this, I'm done. I can move on, do something else, and I just made $300. So let's do place the order. And here you can see that it was placed, and we can do the order status. Two contracts, it did it for one. So here, it's right here, you can see price improvement. So they actually did a little better for me. They made it an extra $14 on the trade. So I probably, when all said and done, I probably did at 156. I did what, 312 minus fees, so 310. So not bad for what, 5 minutes of work, and I've made over $300. And again, if Coke drops, and I think it will, I can close a lot of these contracts, especially this one being at $75. If Coke drops to 55, you'll notice the value of these cover calls will go down fairly rapidly. And in the past, I've been able to close quite a few. And I typically have not run into trouble with them. I got several assigned many years ago, I believe back in 2017, but I have not had any assigned in a long time, and mainly because I realize I can roll them. So when they come close to expiration, I find their cover calls are really easy to roll. So so for a little bit of work, in my mind, it's one of the least risky types of options to sell, and you can use it to boost your returns. And in my mind, it's a lot less risky. So I hope you enjoyed this. I hope it was fairly understandable, and hopefully stay tuned for the rest of the video. Thanks for joining me.